Please welcome National Association of REALTORS 2021 President Charlie Oppler.
Good afternoon and welcome. I'm Charlie Oppler, 2021 President of the National Association of REALTORS. The NAR leadership team is excited to help drive forward the critical work of GSE reform in cooperation with you and our other partners. I don't think I have to tell you, this audience, how important Fannie and Freddie are to the soundness of the American economy. All we have to do is look at 2020. When the crisis hit, the Federal Housing Finance Agency allowed Fannie and Freddie to purchase mortgages in forbearance and to offer affordable payment plans when forbearance ends. It provided flexibility for appraisers, homeowners, and closing agents to respect their concerns about face-to-face meetings and safety. Within short order, the Federal Reserve Board also announced it would purchase mortgage-backed securities made by Fannie Mae and Freddie Mac. Rates fell to pre-crisis levels, and we know what happened then. In May, home sales rebounded and housing became and remains one of the bright spots in a sluggish economy. Clearly, the secondary mortgage market is key to housing affordability, to facilitating home ownership and rental opportunities, and to ensure the adequate flow of mortgage capital in good times and bad. Given the important role GSEs play in our economy, it's important that Fannie and Freddie transition from conservatorship be very thoughtful. We must ensure against market disruption that would limit credit or increase fees. NAR wants to help lead this process. In February 2019, we planted our flag with our proposal that the GSEs should transition out of conservatorship into market utilities. This week, our 2.0 white paper, GSEs, Their Viability as Public Utilities, was published in the prestigious journal Housing Policy Debate. NAR's thought leadership clarifies why and how Fannie and Freddie should transition. Under NAR's proposal, the GSEs would be rechartered and privately held utilities which pay dividends. A utility structure which allows for private capital investment helps protect taxpayers against bailouts. In addition, the mortgage giants' products, rates, and operations would remain under government oversight to ensure they comply with their mission. As a public-private collaboration, a utility will be best able to uphold three imperatives for the market and for consumers: maximizing credit access, minimizing taxpayer risk, and keeping costs down. As the incoming administration prioritizes COVID relief efforts, we know housing will continue to help lead our country's economic recovery. We see it every day. Our goal today is to kick off a deeper discussion on the steps needed to make the utility option even more viable while preserving what works now, so we can support underserved markets and maintain liquidity under all economic conditions. We're delighted today to have with us the authors of this research: Dr. Susan Wachter of the Wharton School at the University of Pennsylvania, Richard Cooperstein, Head of Risk Management at Andrew Davidson and Companies, and our own Ken Fears, NAR Senior Policy Representative for Banks, Lending, and Housing Finance. After our first panel focused on the research, our second and equally distinguished panel will offer industry perspectives on why this structure makes sense. These panelists are Michael Calhoun, President of the Center for Responsible Learning, Don Layton, Senior Industry Fellow at the Joint Center for Housing Studies of Harvard University, and former CEO of Freddie Mac, Jerome Levy, Senior Director of Government Affairs at the National Community Reinvestment Coalition. Finally, we'll close each discussion with a panelist Q&A led by today's moderator, Isaac Boltansky, who is the Director of Policy Research at Compass Point Research. We look forward to your questions. Now, before we get started, I want to share a few administrative notes. Webinar information will be available online, including summaries of this latest research after the event. If you have questions, please add them to the Q&A box. Moderators will share your questions with the panelists in the Q&A following each panel discussion. With that, let's get started, and I'd like to turn it over to Isaac.
Thank you, Charlie. And thank you all for joining for what should be an interesting and timely event. There I am. Thank you, Charlie, for framing today's event so perfectly. And so I think that it's not just an intriguing concept, but it's also a timely concept, an issue that we need to address. Look, the housing industry is roughly 15% of GDP, but two pillars of this industry have, honestly, their path forward is still incredibly murky from a policy perspective. So as Charlie said, and to that end, we have our first panel is dedicated to the authors of NAR's, quote, vision for housing finance reform, unquote, which was first proposed in the spring of 2019, as Charlie mentioned. And it calls for transitioning the GSEs to a utility model. So as Charlie mentioned, there's going to be a short presentation here from the authors, and then we will have a dedicated Q&A period at the end of their presentation. So without further ado, let's introduce our speakers. First up is Ken Fears. Ken is an economist by training and has developed a deep expertise in housing markets, dynamics, taxation, and finance over 18 years at NAR. NAR's interest in the conventional housing finance arena. Next up, we have Dr. Susan Wachter. Dr. Wachter is well known to this group in her current position as a professor at the University of Pennsylvania's Wharton School from her time as an assistant secretary at HUD during the Clinton administration and her more than 200 scholarly publications. Finally, we have Richard Cooperstein from Andrew Davidson & Co. Richard is also no stranger to anyone around mortgage finance. He's held senior positions at Freddie Mac, Ocwen, HSBC, Ranieri Partners, and elsewhere. He also has experience at both GAO and OMB. Richard is a published author and experienced speaker on mortgage finance and the economics of financial policy. Look, all of their bios are on the website. They're longer than any book I've read recently, so you should take your time and go through those. But I want to be cognizant of our time and hand over the proverbial mic to the panelists. So Ken, the show is all yours.
Thank you, Isaac. I appreciate the introduction and for you taking your part here. Welcome back, everyone, to NAR's third discussion or policy forum on GSE reform, and second, really exploring the concept of a market utility. We're pleased once again to be joined by our co-authors, Richard Cooperstein and Susan Wachter. And could you advance the slide, please? Perfect. Back one. We're missing a slide. Well, regardless, go ahead and advance it one. This time we are delving into a new paper to answer two of the questions that were left unanswered following our last our presentation back in the spring of 2019. First, one of the questions that came out and has been punted around ever since regarding a utility is, will investors come to utility style returns and under what conditions? We'll be answering this further on in the discussion, but first we wanted to level set and make sure that we have a common understanding of why a utility and what exactly Fannie Mae, Freddie Mac do in their stature in the market. So first and foremost, what is a utility? Really, it's a collaboration between the private sector and the government to provide a good that the public demands, and that can't be produced efficiently by the private sector. And so coming together, the private sector and the government work together to produce this good in the most efficient way possible, preserving private market or competitive outcomes and in the best way possible. Slide, can you advance it, please? So what do Fannie and Freddie do? Most people understand that Fannie and Freddie buy loans, they bundle them into mortgage-backed securities, and then they sell them to investors around the world with a guarantee. So there are a number of functions that are tied up in this, whether it's securitizing or guaranteeing or limiting the risk in the production process. But oftentimes when we hear them discussed, we hear them referred to as a duopoly. And so we wanted to look at this, and if you look in the chart on the right, this data comes from the Urban Institute, but a number of groups produce similar information. What you see is market share. And really what we're talking about is market share in the guarantor function. And what you see here is the blue bars on the bottom is the agency market share, and it's typically between 40 and 50% of the market. The yellow is portfolio, orange is actually FHA, VA, and rural, and gray is PLS. So again, they're only half the market in normal times, which means that there is competition out there, whether it's the government sector or portfolio, which is 30% of the market. In fact, there are hundreds of other entities that securitize and nearly 5,000 entities that provide a guarantee. And we get into that in more detail using HMDA data at the end of 2019 in the paper. Can you advance the slide, please? Now, where they actually are a duopoly, again, is actually in that blue sector that we're talking about. Within the agency space, they actually control much of the infrastructure, as you would expect a utility to do. And this is a major transition from 2005. And to the credit of the early designers of reform and the conservatorship, what they did is they forced Fannie and Freddie to begin to shift a lot of the rate risk and credit risk off their book and into the private market. And to do so, they had to stand up the agency mortgage-backed securities market and start selling off those mortgage-backed securities in bulk to the private sector. And the vast majority of them are actually in private hands today. So you've got private investors competing in this space. And then on the other side of the hat, with respect to credit risk, the agencies have stood up their own credit risk transfer markets and now curate those, making them very deep with hundreds of investors in those markets. So to this extent, there's more competition in the agency space and thus the overall market than there ever has been prior to conservatorship. And this chart here on the right-hand side really depicts this kind of flow. In the primary market on the right-hand side, which you see is lots of competitors in the origination space and for servicing, until that raw product comes to the agencies and are either as mortgage-backed securities or turned into mortgage-backed securities, and then their risk components are split off and sold into the markets that they curate for rate risk in the MBS or credit risk in the CRT markets. Thus, Fannie and Freddie have been transitioned from essentially hedge funds that borrowed at implied government-backed cost for borrowing and to buy mortgages and held in portfolio and benefited from the spread to the market rates. Today, they actually essentially are companies that are market makers, and they manage the infrastructure for these markets for CRT and MBS that produce this critical product. They provide this critical function for the market. And an excellent demonstration of that was at the very end of the chart in the previous slide, those blue bars at the very end over the last 2 quarters, we've seen their market share shoot to nearly 80% of the market. So not only in a crisis are they critical, but in normal times, they're critical for supporting competition in liquid markets in mortgage-backed securities. As I mentioned earlier, they're more like a market maker in managing these markets, much like the Chicago Board of Trade or the parent company, the Chicago Mercantile Exchange, which manages them. In fact, the CME is actually a SIFMU, or a systemically important financial market utility. And to discuss that concept in more detail, here is our co-author, Susan Wachter.
Thank you, Ken. Could you advance the slide? So what is a systemically important financial market utility? Well, it was established actually under the Dodd-Frank Act, Section 7. And as Ken mentioned, there are several of them, including the Chicago Mercantile Exchange. SIFMUs are critical to the financial stability of the overall market. And to quote the language in setting them up, a failure or disruption to the functioning of a financial market utility would create or increase the risk of significant liquidity problems spreading among financial institutions and thereby threaten the stability of the US financial system. So clearly the risk of failure of the GSEs would threaten the stability of the US financial system. Next slide, please. The structure that we propose promotes competition, but it also promotes stability. And that is the purpose of the SIFMU. Competition then for both two markets, for the TBA market and the CRT market. And the CRT market not only efficiently prices risk and offloads risk to the private capital, but it also provides indicators and information on how markets are pricing risk, which is really potentially useful to the GSEs in setting their guarantee fees. Also, what's important is standards to ensure these markets are liquid and resilient to cyclical risks. Both entities, of course, have scale economies and infrastructure, and this is critical along with research. So what's important is that these entities compete on service, but not compete on standards, not enable races to the bottom, either in standards or on prices of G fees. And if the stability can be maintained, and we believe a utility would serve to maintain stability, then the GSEs can advance the overall mission of serving the underserved as well as protecting taxpayers. Next slide, please. So the public role is to maintain well-functioning markets, achieve stability, orderly markets through maintaining standards and appropriate G fees. And accomplishing this does then enable lower G fees and enables advancing affordable housing finance. The GSEs have already achieved much in conservatorship. There is a national infrastructure standards. There are, as Ken clearly went through, there are liquid debt markets for interest rate risk and for credit risk. Before conservatorship, on the other hand, these were undercapitalized entities. They were not well regulated, and they were shareholder driven given the lack of appropriate regulation. Next slide, please. Going forward, we need an enhanced regulator that will regulate returns appropriately under private ownership and also oversee maintenance of capital and the mission. That way, taxpayers will be protected, and most of the interest rate risk and most of the credit risk can be intermediated. There also would then be capital in front of the taxpayer. We need for that stockholders, and we need a board. That's in the future. And of course, we need some oversight, but very critically, both in maintaining standards and maintaining G fees, not too high, not too low, with the market, the CRT market, informing the level of risk and with oversight for cyclicality. Next slide, please. So the next question is this feasible? Will future investors accept utility-like returns? And if they will, that of course will then make the cost of the GSEs lower, and that can affect and deliver more affordability. The paper addresses this, and let me turn to our co-author and Richard Cooperstein to go through the details.
Thank you, Susan. So I presume I don't have to convince anybody that the cost of capital for utilities and the rate of return for utilities is lower than for other companies. This is a simple data publicly available from MSCI about the stock price returns and dividend returns to the utility sector, MSCI's broad index, looking at standard deviations, the price earnings ratio and the price to book ratio, all of which showed, everybody knows there are lower growth expectations, lower return expectations for utilities. And one question is, well, why do investors tolerate lower returns for utilities? And the answer is because they're in limited markets based on the franchise they receive from a government entity, so that the returns are more stable, reducing the risk and lowers the cost of capital. And just for point of information, by far the largest component of the GSE's guarantee risk fee is the cost of capital. So if you want to lower costs for consumers, you want to lower the cost of capital. And the higher risk, first-time borrowers, the expanding market borrowers that require more capital, the benefit's going to be larger. Go to the next slide. So we're pretty sure that utilities have lower returns. So what does that look like? Well, typically returns for utilities, and they request rate permissions from their regulators, is in the 6 to 8% range, and it varies based on what kind of utility it is. If you looked at the returns for large banks, it's in the low double digits. They have deposit insurance, and keep in mind, they don't use secondary markets, they have portfolios. So they have balance sheet risk, and they have consumer loans, credit cards, business loans. And then finally is the mortgage REIT sector, the real estate investment trust sector. They pay a 7 to 9% dividend, and their stocks generally priced at book value. They're not systemically important generally, although their capital certainly is. They have no federal backstop. And you might say, well, why are you comparing them to REITs? REITs are a lot riskier. But, well, they are. So what if we thought about common stock dividend with a 4% dividend? And you compare it to utilities, which are paying 3, and REITs, which are paying 7. I said, well, you might take that. And then what if I said, well, you're only going to get that 4% dividend half the time? And say, well, no, that's not really what I want. Well, if instead, what if I said you could get that 4% dividend 99% of the time? And further, if the federal regulator was going to make sure that that company could always charge enough to cover that dividend. And what if I further said that there would be enough capital and revenue in the franchise so that even in a repeat of the financial recession from 2007, you wouldn't lose many money. Advance the slide. So if that was the circumstance, you might be interested as an investor in buying a stock that paid a 4% dividend that reliably. And the question is, well, how do you know that's true for the GSEs? And fortunately, certainly once they went into conservatorship, there's plenty of data out there on the mortgage portfolios of the GSEs going back 20 years or more. And that can be modeled. And what you see here are different examples running the actual portfolios of Fannie Mae and Freddie Mac at the loan level for their entire portfolios through simulation and market models to see, well, what's the distribution of outcomes? If you're an investor, you want to know two things. What do I probably get as my return? And what's my worst case scenario? And if you know those things, you can make a decision about whether to invest. The blue line that's to the right is the density function of returns with a 12% cost of funds and 4% capital, both of which are in the neighborhood of what's been discussed by FHFA and some others. And when we run that, there's no scenario where as an investor you get less than 3%, and the expected return on a probability weighted basis is 12%, which in my view is way more than an investor is going to require for a franchise stood up and protected by the government and regulated by the government to not get into risky activities. The part that I focus on are the green and blue lines, which are targeted around a 6% central tendency of total return, where you might think, well, 4% dividend and 2% steady growth. And where they cross the zero line is the amount of time or the percentage of time that as an investor, you would lose some equity. And on those regimes with well-run enterprises and well-regulated enterprises, they'll lose money 1 to 3% of the time, which means even in 2007, as an investor, you would have not lost any principal. So this is what leads us to say, if you set them up well as a utility, you're going to enjoy a much lower cost of capital, which means it's a lot better for borrowers, especially borrowers on the margin. And you've relaxed investors that they've got a good solid return in a well-regulated enterprise that's just serving the guarantee market, leaving plenty of private capital to absorb credit risk and interest rate risk. Go to the next slide. So how do we get from where we are to where we want to go? So one thing to do is to remind ourselves that what the mission of the GSEs is. It's to support the secondary market. This is from the congressional law. Support the secondary market and provide access to mortgage credit in all markets at all times and advance fair lending. It's not how much capital can we have so that we don't have to worry about anything. They have to achieve a mission subject to capital. To do this, FHA is well on the right road as a regulator, but the construct that we think about is the Financial Stability Oversight Council. You know, there's $5 trillion of GSE mortgage securities. So I'd want to see FHFA backed up by a regulatory structure that includes Treasury and HUD and some of the other agencies, so they have the proper muscle to regulate these franchises. And the other thing that's important to do, both for investors and for consumers, is refine the rate of return that you want to be setting for the GSEs. And it doesn't have to be exactly at 6, it could be 5, it could be 8, but I can tell you, back when I was at Freddie Mac, I wish there was a regulator who said, you guys got to charge 50 basis points at least. That might have eliminated them failing in the first place. And the next thing that needs to be done is to correct the risk-based capital standard. The 2018 proposal was close to what we needed. It was risk-based, and a little bit of refining would have gotten us there. I think it's a little further away now. The the next thing to consider is FHA is a subsidized program for first-time home buyers and low-income buyers and low-wealth buyers. The GSEs are a no-subsidy federal franchise. So they should pay for the risk that the federal backstop provides, so that it's a no-subsidy program. And credit reform, which has been in place for a few decades, is well suited to do this. And CBO writes studies periodically about precisely how to get at this. And then before you get to shareholders, you need to finish setting up the regulator, set up board governance and election and seats, and decide, in addition to shareholders, how you want other important parties in the mortgage market involved, the housing advocates, the securities investors, and then finally continue to retain earnings, which has started recently, and have someone in the capital markets work on the IPO. In my opinion, the thing to do is issue 4% dividend common stock and figure out where it trades. And the rest of the business model for the GSEs, as Ken mentioned before, is substantially in place. They no longer have giant portfolios exploiting the GSE franchise. They're selling the interest rate risk into the market, and they've sold nearly half the credit risk in the market through the credit risk transfer market, which is exactly the kind of market discipline that they should be following. I think I'll go to the next slide. All right, Ken, I'll turn it back to you.
Great. Thank you very much, Richard. I appreciate all those thoughts. Just to follow up on Richard's point, there is a road ahead, some of which can be done administratively, some of which can be done congressionally. In fact, some of the things that Richard alluded to may require additional powers. We need to look into that more. But the first point would be that this event is really a kickoff. A lot of people have been discussing the notion of a utility, the ability, opportunity for a utility. We really need to come together and begin to do the deep thinking on what that means going forward. And that means we need to broaden the umbrella and bring all the groups, interested in groups together, and shed more light so that the groups who want to find out more can see the opportunities that the utility model can really provide for everyone. So with that, Isaac, I think we have about 20 to 25 minutes for some Q&A at this time.
Great. Thank you all for that. I think that was a wonderful level setting and a great update to what you all produced back in 2019. So what we're going to do now is I'm going to ask the authors a few follow-up questions, but we want to foster a broader conversation with the audience. So to that end, if you have any questions, you can use the chat function, which you should see at the bottom of your screen there. You can just hit on the tab Q&A, should pop up a window where you can enter your question, and we're going to do the best we can to get to all those. But I'm selfishly going to go first. So I'm going to basically start with a foundational question. And look, while I find mortgage finance to be electrifying, it doesn't exactly have similarities to power utilities and electrical utilities. And I know that's foundationally one of the parallels you're drawing here. So I wanted to start with Susan, if I could. And if you can, just try to help us think about structural considerations given the inherent differences between power utilities and mortgage guarantee.
Thank you, Isaac. That's a good question. And clearly the GSEs are different than electric utilities. In short, the purpose of regulation of the electric utilities is to keep the lights on. And in this case, it's oversight of the GSEs is not literally to keep the lights on, but rather to keep financial markets open and stable. So the key is to set guarantee fees as well as standards and operation. but going back to guarantee fees over the cycle to maintain stability. And we believe that can be done and that much is in place already to accomplish that. And if that's accomplished, then the broader mission of serving the entire market can be accomplished better as well.
So unless anyone else wants to jump in, I'm going to go to my next question, which is to Richard. And you know, Richard, I know that the paper covers this, and I think you discussed it in your answer, but I just wanted to give you another second to talk a little bit more about how realistic you think a 6% ROE is, and talk about in the broader context of through a cycle, which I know you touched on.
So there's 2 points I would make. The first is it's pretty clear that utility cost of capital and returns are lower than for companies that are not in limited markets protected by a franchise. So that's going to contribute to lowering cost of funds by 2 to 3 points, say. The question of whether it's exactly 6 is sort of secondary. Could it be 8? Yeah, okay. It's also the case that capital is made up of equity and debt. And as the GSEs have sold $50 billion in mezzanine credit risk at about a 4% cost of funds, that lowers, let's just suppose for fun they needed 50 billion of CRT and 50 billion of equity. They need more than that, but just in a simple way, you have 50% at 4 and 50% at 8, and you get to 6. So it doesn't really matter if it's 6. The point is a utility structure has a lower cost of capital than companies that are not in limited markets. And as relates to a question about, well, what about minority borrowers and marginal borrowers? If to the extent they're riskier and they require more risk capital, the lower you can get the cost of funds, the lower the guarantee fees are. So the impact of lowering the cost of capital is highly progressive. It makes a much bigger difference for riskier loans at the higher end than it does at the lower end. And so if you're not going to if this isn't the segment to subsidize, the best thing you can do is get the cost of capital as low as possible. And that brings the LLPAs down at the higher end. I guess I'll make one more point about competition. Where we see competition, the most important place is competing to provide capital for interest rate risk and credit risk. And by ensuring the GSEs sell most of their risk, that's how you get the most possible competition and lowest possible cost of funds for the interest rate risk and credit risk. Having more entities compete with each other starts looking like the mortgage insurance industry, where you can have destructive competition becomes much more likely.
Hey, Isaac, I just wanted to follow up on something that Richard, the point that Richard made. While it may not be 6% or 8%, the point is that the return could and should be lower than what's being priced into today's guarantee fees. And that difference is what helps to pay for the charter duties. And so that relationship is very important. The better, more efficient this construct is made, the more attractive it is to investors because it makes the returns more stable over the long term and therefore opening that ROE. And whether it's 6%, 7%, 8, 9, doesn't matter. It's better than it could be today, I think is the point.
Understood. That's helpful. I'm going to stick with you if I can, actually, Ken, because the next question that comes to mind with this, and it's actually reflected in some of the questions that we've had submitted so far, is about governance structure. And we know governance structure is vitally important in all things, but especially so here. So I wanted to give you a minute to help us understand a bit more about who would be calling the shots in this model. And really, how can you ensure that purely political considerations wouldn't creep into the policy-making process for the utilities as you envision?
Now, that is a great question, and it's one that kind of bedevils almost any of the varying plans that have been proposed for the GSEs at the end of the day. But we view it a number of things that can be done to help insulate the process. First, as Richard pointed out, having FSOC designate the GSEs as SIFMUs allows for their regulator to essentially have a backup. FHFA would have a backup and the ability to develop the tools as it sees fit to stand up to this challenge of $5.5 trillion regulated entities. You know, this is a very significant and unique challenge, and they need that flexibility in their toolkit to be able to do so. But when we look at the FHFA itself, and here's a point where we, NAR has its own policy, not necessarily in conjunction with our co-authors here, but we argue that the FHFA should be migrated rather than a director removable with cause to a panel and a bipartisan panel of experts, industry experts, that would be reviewed and passed by the Senate. So we think there needs to be at the top a level of insulation, but also as we begin to build up the commission that would look at pricing and other parameters that this entity would have to fulfill, whether it's created outside of the FHFA or internalized to the FHFA, that construct needs to be bipartisan as well. And specifically, we look to the examples of like the Federal Reserve, which actually is a mutual, not very uncommon from a utility construct, but it's a mutual and it has a board that sets rates, as we all know. And they've done an amazing job of insulating it from the political process. So if we could, we would migrate not just from a bipartisan kind of panel, but a nonpartisan kind of panel and develop that same kind of esprit de corps. And on that last point, a commission that's setting pricing, I just want to clarify one thing that may not have made it to the surface before. We're not arguing that the regulator should be setting pricing. Rather, what we're arguing is that there should be a band of returns and that the regulator should really set the cap and the floor. The cap being so that these entities can't go rent seeking, so they can't exploit the market and charge higher fees than they need because of their monopolistic or duopolistic power. On the downside, we want a floor so that they don't start underpricing to the point that it doesn't reflect the amount of capital that they need. Likewise, they can't underprice to drive competition out of the market to gain market share in an uncompetitive manner. So again, we're looking at that band, not setting a particular price or guarantee fee, but a band of ROEs and allowing the private sector to fluctuate in between there, really just collaring the two.
That's helpful. So I'm going to shift back to Susan if I can. Look, so we've heard about the underlying economics. Ken just helped frame some of the governance structure issues. My question is now to Professor Wachter and just give us some broad thoughts on why any private investor would want to invest in these entities, given that there are political ties and an interwovenness there.
Well, there is a business model behind the GSEs, and the business model works. The business model generates profits. The profits go to support the mission, but there is, particularly under stabilized model going forward, potential, as our paper shows, for stability that delivers returns to shareholders that I would call utility plus. There's enough range there that, as Ken emphasized, more stability, lower the rate, but even so, the rates are even today sufficient to generate mission-driven outcomes as well as return. Implicitly, the return that is being shadow return that is being assumed today is 12%. which is sufficient, should be sufficient, and will be more than sufficient if a utility model is in place which guarantees stability over the cycle. There are investors who prefer stability, and they'll pay up for that in the form of a lower rate of return.
That makes sense. Sorry, I'm going through all of the wonderful questions we've gotten. I'm going to do my best to get to all of them. I'll throw this one over to Richard if it's all right. Richard, what's your viewpoint? Will investors suffer as the utility takes on, quote, endless social goods investments, unquote?
It would. So our thinking here is this is a no subsidy market framework that's as efficient and takes advantage of government resolving imperfections in a competitive market. There's certainly room for a duty to serve utility to provide for expanding markets or other efforts. It's a matter of degree, really. How big is the moat that the government sets around the GSEs to operate? The bigger that moat, again, unsubsidized, the more they'll be able to take money from returns or risk and put it towards housing goals. So you can certainly do that. Our feeling is let's say my feeling is if you want to subsidize, go through Congress and allocate the money, or put it through FHA, which is a subsidy program. And you can take some economic rents out of these, but you're limiting their returns in the first place. And the other point we'd make is they're selling most of the risk into the market through MBS and CRT. And so for the most part, if the competitive capital markets are pricing and taking the risk. And I think in the long run, that's what we want. And one of the reasons we worry about a government corporation is that market discipline gets removed. And it's pretty clear, in my view, from the first FHFA director balancing the playing field between the corporations and the regulator to stabilize credit risk and business model and rates, up through using CRT, and then to a current viewpoint in FHFA that didn't have a check of a board or shareholders about what the most effective business model was. So I'm left with, you're going to need a strong regulator, and you also need a board and shareholders. That's how private utilities work. There are hundreds of them, and mostly they're set up as privately owned and government regulated. And just one more point. So when the pandemic hit and financial markets locked up, the GSEs didn't have giant portfolios and they couldn't buy MBS. But it was the easiest thing in the world for the Federal Reserve to decide on behalf of the taxpayers and the financial system that they should buy several $100 billion of MBS. I think that's exactly the right way that a utility should work. It's got no business making decisions about when to buy MBS on a market exploitation basis. It's a public sector decision that the Fed is a good place to make that. So, and if they weren't the GSEs, how is the Fed going to do that? There is no place for them, no place else for them to go to buy MBS to stabilize spreads in the market. But because Fannie and Freddie's securities were out there and they didn't own them, it couldn't have been easier for the Fed to solve the problem they were facing.
Hey, Isaac, just want to chime in on one thing that Richard pointed out is that there aren't just hundreds of utilities across the country. There are thousands. There are more than 3,000 water and electrical utilities across the country, and they've been around for over 100 years. These are very well known, very well understood, very honed in terms of oversight and relationship and parameters and commission setting. There was a question earlier about whether it's an appropriate analogy. And that's a fair point. You know, electricity and water are different entities. They don't have a cyclical component to them, you could argue, in terms of the product themselves. However, in terms of the market, there's upsides to a national franchise with a single powerful regulator and a waterfall of other regulators right behind it. You're going to have much better, frankly, infrastructure and a much larger market to spread those costs over. Rather than $1 million at most in a local utility, you now have tens of millions of consumers to spread your costs over. So arguably it's a better franchise than some of these small disparate local utilities. So thank you.
Great. That's a great distinction point. I'm happy you made it. I'm going to throw the next one to Susan, given her work in this field. It's from our friend Ed Golding. Why not give FHFA the ability to charter new GSEs? They can set parameters on when to approve, but potential for entry is very important.
Of course, that would be Congress's decision. And the consideration of having many GSEs has been in front of Congress people and at large policymakers. My concern with the framework of having many GSEs, as an economist, of course, there's some appeal to the idea of having, 10, 20, 30 GSEs. That's kind of competitive. You'd have to have 30, 40. So then what would these entities be and how would they operate? Certainly they would not 30, 40 have an infrastructure economies of scale. How would they maintain the CRT market? How would they even maintain the TBA market, which is critical for a 30-year fixed rate mortgage? So that pushes back to, no, we really can't maintain a TBA, CRT, well, particularly TBA with maybe even 10 or 5. You can't have competition. Well, certainly what you could have is you could have 100 GSEs which are exactly regulated in the same way. Regulated for market, making sure that they don't cream skim, regulated for rates, but that would be very similar to FHA. And ideally, with the GSEs, we can have both the private market risk-taking, protecting shareholders, and oversight to prevent financial meltdown. I don't see how that works in a competitive environment with many, many entities on the downside underpricing for risk, racing to the bottom, and on the upside paying out perhaps and not maintaining enough capital. We need to oversee these entities, I believe, to prevent kinds of meltdowns that were demonstrated in the great financial crisis. That takes us to a situation where we have 1, 2, maybe we can have 3, 4 possible, but certainly 10, 20 would be out of the range, and therefore we don't have competition, therefore we do need regulation. And a utility framework feels to me as the best regulatory oversight framework.
Susan's absolutely right. If you want liquid securities, which is the best way to keep costs down, the collateral underneath them must be consistent and homogeneous. And even with just 2, Freddie Mac had tremendous problems with security performance because their securities were deemed not quite the same as Fannie Mae's. And if you set standards so that these GSEs are taking risk consistently and providing the same fair access to credit, they're basically 100% correlated with each other. So what do you gain by having more of them, except having more companies to chase around who have less diversification, higher fixed overhead costs, and you start worrying about what if their share high enough. So we're pretty sure the way to get competition is to make them sell the risk, a substantial portion of the risk, into the market. That's where the competition and discipline comes from.
So Ed pushed back a little bit and said the
Yeah.
VA and FHA go into Ginnie Mae, and those two programs are very different. I've got my own questions, but if you want to take a swing at that one, I thought that could be an interesting retort.
All right, so where,
Well, I think the general point is you have two different feeders into the Ginnie securities.
and they have problems periodically. I'm not sure. I mean, all of us who know those programs worry continuously about the amount of funding they get through the federal budgetary process to maintain the infrastructure and control the risks in those programs. So that wouldn't be my idea of a thing to copy.
Understood. We're running out of time here, and I'm going to try to bundle in a bunch of different questions that we've gotten, and I'll open this up to whomever would like to take it. But effectively, the question goes as follows. Number one, the mortgage market works right now, so why do anything? And the second question is an offshoot. If you are going to do something, what would you recommend is paramount in order to ensure a seamless transition without the execution risk we know has sunk previous efforts at GSE reform? So why do anything, and how can you be sure that it won't mess up the market if you do something?
I'll jump in and take a stab. So why do anything at all? I think it's a false assumption that this boat will keep going in steady waters going forward. We've already seen that a director, if a director, he or she has a particular perspective, the FHFA can steer the GSEs in a particular direction to the detriment of either future investors or the charter goals and the charter mission. So on that front, we see that there is inherently political risk in the current structure, and likewise, they aren't very well politically insulated from Congress at this time. So if we want to lock down what we have today, we think this structure, the market utility structure, is the best way to do that and the least risky. We can take it in a two-pronged fashion with a lot of administrative moves, revisiting some of the changes that have been made over recent years and tweaking them towards more of a market utility and really locking in what we take for granted today, that this structure that has performed so well. So that's my argument for why to move forward in terms of moving them towards or out of conservatorship, is that it isn't clear that we actually, like what we have today, can survive over the long term.
And my opinion, things are worse than they were a year ago or 2 years ago, because there's only a regulator and there's no shareholders and no board. So things got a lot better 10 years ago when FHFA had appropriate powers. Things got way better pretty fast as the tensions rebalanced, but that's no longer true. So the fact that CRT has basically been eliminated as an economic tool for the GSEs, that's a terrible sign. So the utility structure works all over the place. I'm not overwhelmed by the government operating company model. I'm not persuaded that is what I want to bank on for the next 25 years.
Dr. Wachter, would you like the final word for the panel?
I think we can deploy the risk-taking and efficiencies of the private market. We need to do that going forward, together with the oversight, with a board that represents experts as well as advocates, as well as industry participants, in similar ways that, as Ken described, the Federal Reserve Board brings in the necessary oversight to bring stability to overall markets for the sake of the mortgage market, which is so critical for overall stability.
Isaac, I can't help myself. I need to chime in on or echo Susan's point, amplify it. We really need to bring in all market participants, not just, obviously we need to bring in consumer voices to bear here. We also need investors, and by that I mean equity investors, but also investors in the CRT and MBS markets, as well as those players in the primary markets. They need a voice in the system so that we know that it's functioning correctly and supporting liquidity on both sides of that bow tie diagram that I showed earlier.
Well, Ken, this is your show, but I think we're going to put a bow tie on this panel. I would like to thank the authors for what's an incredible amount of work that went into the first paper, the second paper, and today's presentation. I hope that you'll stick with us as we move on to a second panel, which is going to provide us with some insight on the utility concept from consumer advocates and industry participants. As we are assembling, I think I'll just provide some brief framing remarks and just start introducing our next panel. Thank you for sticking with us. I thought the first panel was great, and I think the second panel is going to be wonderful as well. In this panel, we're going to get to hear the perspective of two of the nation's leading consumer advocates and one industry veteran. And in terms of the panel structure, it's going to be very similar to the first panel, except this time instead of one group presentation, each one of our three speakers will provide a brief presentation, and then we'll get into the Q&A. So if we can pull up the introduction screen, I want to first start with Don Layton, who is currently a prolific author in his role as a fellow at Harvard's Joint Center on Housing Studies. Prior to that, Don was the CEO of Freddie Mac from 2012 through mid-2019. He spent almost 30 years at JP Morgan and all of its predecessors, starting, which I love, as a trainee and exiting as their vice chairman. He was chairman of E-Trade during the crisis. He was appointed to AIG's board by the US Treasury Department, so he knows a thing or two about large, complicated, government-owned financial firms. Next up, we have Jerome Levy. Jerome serves as the Senior Director for Government Affairs at the National Community Reinvestment Coalition. She's an attorney with 20 years of federal and state government affairs experience. She served in the General Assembly for my home state of Maryland. She also served as an assistant director for the legislation department at the AFL-CIO and as a legislative representative for the Laborers International Union. She lobbied Congress on a host of laws and wages issues, working conditions, immigration, trade, healthcare, and pensions. She also served as senior staff for former U.S. Representative Gus Savage and U.S. Senator Dianne Feinstein. Finally, I have the pleasure of introducing Michael Calhoun. Michael is the president of CRL, the Center for Responsible Lending, which is the policy affiliate of Self-Help, the nation's largest community development lender. And Self-Help has provided over $6.4 billion in financing for first-time home buyers in small businesses. The CRL is a nonpartisan, nonprofit research and policy institute focusing on consumer lending issues. Mr. Calhoun is no stranger to all of us on the line. He has been an active participant in consumer financial legislation and regulation, and he has more than 30 years experience in consumer lending. So now that I have all of that out of the way, I get to hand the mic over for the first presentation to Mr. Don Layton.
Hey, thank you, Isaac. Can we put the slide up, please? All right, I'm going to try to quickly go over slides. I am definitely a utility model supporter. I want to tell you how I got there. It's a very different perspective as an insider running Freddie and as part of the conservatorship, how I got there. And I guess maybe my definition of what a utility, how it would run is somewhat different, but bear with me. It's a very pragmatic approach. Next slide, please. As a reminder, we've gone through a lot of gyrations about what to do with the GSEs. The Obama administration policy from 2008 to its end was to wind down the two GSEs. They had lost their credibility with the politicians and the public in going to conservatorship, and it was to get rid of them and replace them with something else. And that was left to Congress to develop to what? Many alternatives were proposed, what I'll call unproven alternatives. Everything from nothing the market will provide to smaller GSEs showing up as Corker Warner, to industry cooperatives, to government corporation, various types, and all these other variations were put up in research papers, different groups. It was, if you will, policymaking, the hothouse of ideas thrown in, and all of them flunked out. Almost none of them identified how to get from here to there. And once they were being examined in more detail below a 50,000-foot general level, they were seen as being messy and destabilizing at best in a transition. When you got to details, while the sponsors of these programs, of course, always were in love with them, not enough other people thought they would deliver the promised results as you started pulling away the covers. Corker Warner perhaps got the furthest, but even then at the end, it was just not going to work as originally had hoped. And the result was inadequate support in Congress to any of these other alternatives and the industry. So legislation has never come close, not even close to this day, 12 plus years later. Next slide, please. And this is my definition. Over time, the policy background kind of changed. The GS, with the failure to come up with a replacement, and the GSEs being reformed in conservatorship and becoming better companies commercially doing what their mission is without all the lobbying, without all the hidden subsidies, they started to become more socially acceptable in policy and political circles. And to my mind, the first people to speak out were the small lender organizations about 2017, and they kind of changed the politics. They basically went, wait a minute, all these unproven alternatives, who knows how they'll really work with all the unintended consequences and all the problems. These are unduly risky. This is an existential issue to us small lenders. We could get swamped in all this. The GSEs are running well now. Quote, this is my summary. Let's just fix the 5 or 6 big things wrong with them and move on. And they identified different groups with what exactly the 5 or 6 big things, get rid of those excessive and discretionary investment portfolios that provided most of the profits. That was an abuse of the system. Those had been eliminated by that point already. No longer undercapitalized, get them a real SIFI type, consistent post-2008 capital system that had been developed in conservatorship. Make sure G fees are leveled by size of primary lender. That was true even by the time I arrived in 2012. No longer use the implied guarantee, the kind of quasi uncompensated for system. Use the PSPA or full faith and credit and get the taxpayer compensated. Keep credit risk transfer. It's really good. Everyone was in love with it. And the topic of today, most would say, let's have them regulate as utilities so they can't abuse their market position to keep G fees too high. This started to be talked about, and from my perspective, this became the dominant theme around that era, replacing the wind them down and replace them with something else. None of those ideas work. People have moved on. Now, this is all part of a reform, recap, and release. I will tell you all that recap and release is largely under the control of Treasury, not the FHFA, and they have done very little work on it to date. So that's mostly a to-come item. Next slide, please. Meanwhile, in conservatorship, to run the companies for a long-term, unprecedented conservatorship, we actually built an internal to conservatorship utility model. It exists. It's existed for years now. You had to come up with a rate base, as they call it in the electric utility world. How much capital do you need to run the business? A SIFI consistent, not exactly a bank type, but a SIFI consistent for a GSE capital model was developed and took several years to do, 2014 to 17, was put into place, and it passed muster. It made economic sense, and the GSEs were using it. Then you have to set G fees to give an allowed rate of return. What should that allowed rate of return be? It was looking at the cost of capital benchmarked to other FIs. And then when it came to rate setting, the focus wasn't single family. There is the multifamily side I won't talk about. You had to make Fannie and Freddie's revenue and profit calculations exactly consistent, which they were not, especially in the cash window. That took some time. And then you had a comparable set of numbers, and the FHFA set an ROE target to hit, not higher, not lower. It was enough to give a proper return to the taxpayer support of the company. If it was too low, it wouldn't do that. It was abusing the situation, was too high, and it was put in. And FHFA declared that pre-CRT. CRT helps raise the return, but it was still a little early days, and so wasn't quite sure what to do with that. This has been in place for 3 years. And it has been, I think, considered generally a success. GFE has been pretty stable. In conservatorship, the fight would be for market share to lower GFEs. They've been stuck in place. I'll also mention that the benchmark cost of capital, which has been talked about in the other panel, it's all theory now. When GSE shares would actually trade in a future, you will find out what their cost of capital is, and what we all think it should be won't matter in the long run. Next slide, please. I have to remind people of this is a very simplified version of the architecture of government support and structure to U.S. housing finance. It hasn't been talked enough about in the last few years. The notion there is that there were 3 tiers. The top tier were rich families, rich being defined as your mortgage was more than the conforming loan limit. Maybe a weird definition of rich, but that was put in place. Above that, private markets took care of you. Then there was the broad middle class, top of the working class. We want to make sure they have access to relatively inexpensive, the American mortgage, meaning the 30-year fixed rate, freely prepayable mortgage. And that burden went on to Freddie and Fannie, which are hybrids. They are shareholder owned, but have a public mission, and they do have some subsidy to the business model. They are not just public mission. There's a specific subsidy available to them. We can talk about it if you wish. In practice, this makes them a hybrid of a government agency and a shareholder-owned company. On the margin, people close to qualifying for mortgages, let's give them more subsidy and put them over the line for the social value. And that was meant to be for the FHA and, with its particular, obviously, idiosyncrasies, the VA. And we'll give them even more subsidy. This was your architecture. The problem was, next slide, please. Managing the hybridness of the GSEs has not gone well. It didn't go well prior to 2008. It ended up too much oriented to politics. The GSEs found the loopholes in the charters to build those in subsidized investment portfolios with the implied guaranteed funds, heavy politicking and lobbying and influencing operations, one of them being to have very low capital requirements. And Congress made it all worse by creating a weak regulator in OFEO and its precedents. The issue today really is, how do we manage that hybridness? Next slide, please. When all you look at these models that came up with all these proposals over the years, the only viable proven one that really can work is the utility model, some version of utility model. I want to define what I mean by the utility model. Number one, we keep the reforms of reform, recap, and release, either via amendments to the PSPA or legislation. We need to keep the GSEs focused on the proper business with no loopholes. Every time you start a new system, you end up with lots of unintended consequences and loopholes. By addressing the 5 or 6 big things wrong with the existing system, we have covered those. We already have learned the bad lessons. And that has worked very well in conservatorship. Also, Congress did improve the regulator. FHFA does not have the obvious regulatory weakness of a FAO where it's subject to too much political influence. The second part is a state PSC, meaning Public Service Commission, the usual people who run this at the state level. The PSC quality pricing and terms, that's what it's called, rate and terms regulation, to be developed and implemented. What was done in conservatorships, a pale imitation of this, because you have to balance two things. On one hand, enough to earn credibility with investors that you won't steal their money by the latest political appointee. And on the other hand, that you prevent implicit collusion to keep G fees too high, which easily can be done between the two GSEs, and as an additional source of discipline in the GSEs to keep them focused on their proper business, the straight and narrow. Right now, it's the only path anyone has shown that is likely successful given the realities of the facts and the politics. And if not, what is the better alternative other than someone's very superficial 50,000-foot general idea? SIFMU has been mentioned by the prior panel. I think it can help contribute additional strength and discipline to the utility model, but I don't think it's really core to the topic. Next slide, please. So for people in housing finance, there's not a lot of familiarity with your typical PSC quality pricing in terms of regulation. More homework needs to be done in this. I happen to have background with some exposure to it. Again, conservatorship is a pale imitation. It got us going. It's not enough. A public utility company model balances shareholder needs versus mission objectives. It is tried and true. It's been in place over 100 years. In the world of real people and real politics, no system is perfect, but it's a very good track record over these 100 years, not perfection. The structure, however, is interesting. Number one, owners get promised in law a fair return. It's not subject to some FHFA head just deciding what they want. An independent commission makes a decision after holding public hearings on required rate of return, where the utilities get to present their case and consumer groups get to present their case, and they issue a ruling. And by the way, they can be sued in court by the owners if it doesn't seem to provide a fair return, although they usually don't win. Lots of professional process, lots of proper process and laws and regulations and precedents to have it all work. Having an FHFA run it with a single head, politically appointed, doesn't even come close to passing muster for this. The implications here are you need a semi-independent commission within the FHFA, or maybe even separate from the FHFA, to keep the politics out and make sure that the regulation runs properly. All the mechanisms for nonpartisanship, as already discussed, need to be chosen. There's the SEC style, that's a bipartisan 3 versus 2 style commission with 5-year terms. There's the Fed nonpartisan, at least nominally, and long tenure style. And they tried the PCAOB to be an indirect appointee. The SEC is appointed them. Politics has invaded all of these. The question is how to keep it to a dull roar, not a giant roar. And you can probably start all this versus PSPA amendments. I agree with that. Eventually, you're going to need legislation to do this. Next slide, please. Almost done. So my conclusion is we're kind of boxed in reality to reform GSE with the utility model. Boxed in has a negative connotation sometimes. I don't mean it this. This is the last one surviving because it's the best. It is workable. We know it works. It can deliver the goods. It's doing it every day today, right now. The transition risk is minimal in comparison to quite maximum in many of the other alternatives. The reforms, the existing reforms, can be locked in via PSPA amendments or legislation to keep the companies in the straight and narrow, no giant excessive investment portfolios, not having unduly low capital, and more. It can ensure G fees are set reasonably and enforced. Implicit collusion is blocked, and you have sources of discipline on the GSEs to keep them. A revised FHFA with maybe a commission or whatever versus a FAO, utility regulation. Not only does it set prices, it approves terms, and a very powerful tool not mentioned is it can disallow costs. If the companies went into excessive lobbying, they can disallow lobbying costs and other things. And SIFU has been mentioned as a possibility to help as well. So to me, this is the best shot at managing the hybridness, keeps the balance between the government agency to deliver the mission and the shareholder owner-oriented company to attract capital nature of the GSEs. I'm not sure there's any other really way that can get the confidence of the market to deliver the goods. And if not, we're looking at the GSEs staying in a utility model with inside conservatorship for the foreseeable future, maybe even decades. So with that, I'll turn it back to you, Isaac, for the other speakers.
Thank you, Don. I think Jerome is next.
Right. Good afternoon, everyone. It's a pleasure to talk to you today about the market utility approach. Really look forward to getting into it a bit, but I think also I really want to chat a little bit about how, our history, NCRCs, the National Community Reinvestment Coalition's history in this area and why we have such a great interest. NCRC has really been deeply engaged in the policy debates around Fannie and Freddie for decades. And the organization's founder and CEO, John Taylor, often talks about the GSEs and the first affordable housing goals that they set in the mid-90s and the uptick in access to home ownership for low and moderate income and minority home buyers that resulted. He's really a passionate advocate for the housing goals and really all the work they do as a result of the mission in their charters. He and our current CEO, Jesse Van Tol, have been particularly active since the GSEs entered conservatorship. We have all come to appreciate how consequential these issues around the GSE's governance, their capital levels, their oversight and regulations are, and are really invested in the outcome of these larger housing finance reform questions. A lot of it has to do with how we view home ownership as the central pathway for most low and moderate income families to build wealth. We have done a lot of work and a lot of research on the racial wealth gaps and the connection between the Black-white home ownership gap, for example, and we see the essential role that the GSEs must play in order for the nation to really close those gaps. They're one part of the answer. They're not the only answer, but they're a significant piece of dealing with the racial wealth gap and the Black-white and Hispanic-white home ownership gap, but also some of the larger affordable housing challenges that the nation is facing. We continue to push to protect the mission in the GSE's charter. We have urged FHFA to set strong and aggressive numeric housing goals and rigorous standards for their statutory duty to serve underserved markets, to fund the Housing Trust Fund and the Capital Magnet Fund, and all consistent with their affordable housing mission. We've also, we've weighed in on many issues, including urging them to improve the distribution of their loan guarantees across the credit score spectrum, as well as their guarantees to certain segments that continue to be underserved, and Black borrowers stand out there, and other communities of color. Overall, their charter and statutory obligations really drive a lot of critical activity at the enterprises, not just their goal qualifying purchases and the cross subsidization in their pricing, but their development of affordable loan products, significant work research into gaps in credit access in the market, their outreach to key housing stakeholders and intermediaries, partnerships and grant making. All of that activity really we think is critical to facilitating access to the market and in an affordable way. For some time, actually, NCRC has and continues to support the end of the Fannie and Freddie's conservatorship. We joined with the Main Street GSE Coalition, a group of small lenders, civil rights groups, housing advocacy groups, to urge that the GSEs be allowed to maintain a capital buffer and, be on a path to eventually exit conservatorship. So why? A lot of it has to do with some of the things that Don Layton mentioned. We were concerned about some of the legislative proposals in Congress, some of the housing finance reform proposals that would have amended the GSE's charter in ways that would diminish their affirmative obligation to serve the market, scrap the affordable housing goals, and just overall diminish the level of and commitment and investment in affordable housing. So really concerned about some of the aspects of the legislative proposal. We also believe that, it's a different market today, better regulated, safer and sounder, because of the Dodd-Frank Act, because of the Housing and Economic Recovery Act, HERA, and just a whole series of post-crises reforms. We thought they are being released into a better market. And quite frankly, we believe the GSEs can do more to facilitate access. And, pre-conservatorship, there were a number of activities that they did that were safe and sound, that supported affordable housing in terms of, equity investments, again, loan product development, outreach, and even some of the nonprofit capacity building work they did through the foundation. We think they can do more around affordable housing. Overall, I would say that NCRC sees the public-private mortgage guarantee model and business at the GSEs as sound and something to be built upon and improved. So in our view, the GSEs as market utility really provides a concrete way to move forward that is prudent, politically doable, and really supports the mission of the enterprises and the affordable housing objectives that we think are really important. It's also preferable to a number of other options that have been on the table. For example, chartering additional secondary market entities, but a number of the other proposals, the government corporation and others, we think this is a preferable approach. And if well executed, can really offer a number of important advantages for the traditionally underserved markets and the borrowers that we care most about. I think the potential for a lower cost of capital with a utility structure is appealing. While the paper makes clear that it is difficult to know the return investors in privatized GSEs will require, there are a number of features that support the market utilities approach as one that could provide better pricing and generate excess profits that would support the enterprise's affordable housing activities. We have said for some time that we believe the GSEs need scale to support a strong cross subsidy, and this approach really recognizes and supports that. A utility approach also offers the potential for more stable and lower required returns on equity, again, to support lower guarantee fees, better pricing. I think the strong endorsement from Don Layton and the presentation he really made around the fact that the GSEs, have the core of utility style regulation of their guarantee fees and just a number of these utility features already in place is also appealing and can bring some stability to the market. We have been very concerned about FHFA's bank-like capital requirements and the impact that those would have, those will have on the GSE's mortgage guarantee business, their role in the market, their ability to carry out a robust affordable housing mission. Also, I will say, while this piece, while the approach outlined today and outlined by NAR has a congressional piece to it, much of this approach can be accomplished administratively if necessary. I mean, if the legislative environment deteriorates and we can't assure that the mission in the charter will be protected, that the affordable housing goals will be protected, then much of this can be accomplished administratively. So overall, I would say we think this approach is a strong approach. It's doable, and it's preferable to a number of approaches that have been on the table. I think it really gets at the mission, traditionally underserved markets, and just the borrowers and the communities of color that we care most about. So I think I'll pass it on to Mike.
Thank you, Jerome, and thank you, Isaac. I want to begin with appreciation for the National Association of REALTORS, and specifically for Susan, Richard, and Ken for their contributions to this debate. Their prior paper and the Realtors' prior symposiums on this issue really were an inflection point in this debate, turning it towards, I think, the broad consensus that we see today that the future should be a utility structure. The recent paper that we're talking about today has added further convincing data and analysis to that proposal. And I think the impact of this can be seen in the recent letter that the Realtors executed along with ABA, MBA, and the home builders, calling for continued capital retention by the GSEs and movement towards release from conservatorship. The debate we're having today is taking place in the environment of a COVID medical and financial crisis, a broad national affordable housing crisis that existed before COVID hit. The Joint Center of which Don is part, has issued sobering statistics that 20 million, going into 2019, 20 million Americans who rent were burdened with unaffordable rent payments, and a large portion of those making less than $25,000 are paying over half of their pre-tax income in rent payments. And then home ownership have plummeted, and in particular has not recovered, and particularly so for borrowers of color, with Black home ownership still being well below where it was back in the late 1990s, indeed back to where it was in the late 60s when the Civil Rights Fair Housing Act was passed. So my comments will be through the lens of the need to do more to address affordable housing and provide racial equity in the housing market. And these are both goals that I commend the Realtors for their leadership in advancing. So the three main points that I want to talk about: first, the impact that the utility structure has on those two particular goals of advancing affordable housing and addressing and advancing racial equity in the housing market. The second will be a separate point not yet raised today about the historic opportunity that recapitalization presents to advance those goals. And the third will be what we have been talking about here today. How do we implement this? What's the process and what are the essential parts of it? So utility structure has two major ways that it helps affordable housing and racial equity, both of which are statutory duties, I point out, of the GSEs. First, it requires the GSEs to focus on their public mission rather than just focusing on the most lucrative part of the market. And this has implications for both borrowers and lenders. As we talked about, one of the reforms is that the GSEs charge level pricing, whether you're selling them 5 loans a year or 50,000 loans a year. Well, anyone in the market knows there are a ton of economies of scale with the larger providers of mortgages. And so it requires, to serve those small lenders who should be served equally, it requires a mandate and a cross subsidy, a pooling of costs to have equal access for small and large lenders, and preventing those many small lenders who exist today from being squeezed out of the market. Similarly, it requires the similar mandate, pooling of costs and risk, and cross subsidy to serve the broad array of borrowers that the GSEs were established and here are mandates that they serve. I would agree more with, I think, with Don's experience and point that the GSEs are subsidized and in very important ways. It is not a no subsidy utility model here. First of all, just by the fact that people are calling, and I think properly so, for there to be 2 of them, and recognizing if you opened it up to more, it would diminish significantly the value of those 2 franchises. And then also the GSEs come to this with a host of advantages that no other market participant has. And indeed, the challenges of a new participant breaking in was one of the reasons that the other models were not feasible, not by any means the only. But they enjoy a backing from the government that reassures investors around the world. They enjoy benefits such as their exemption from regulation on and registration on the securities. Their bonds are tax exempt at the state level. They have used during conservatorship, have built up massive technology, which is important and a good thing, but they have done that with the support that they have been able to secure during conservatorship, and they possess proprietary data that gives them a huge advantage in a market where technology and data are some of the most important assets that you can have today. And so, as Jerome said, they have those advantages and they should use them to advance affordable housing and racial equity in the market. And the analysis in these papers showed that they are able to do so. That, for example, the current 10 basis point payroll tax fee does not price them out of the market. And if they had no cross subsidy, a free market analysis would say that it should, other things being equal. The second way, and Richard really pointed this out, but I want to emphasize this, is utility reform is one of the most important affordable housing reforms. The cost of the catastrophic cost capital is the largest, well more than 50% of the cost of the G fee. And it is allocated in a way that it falls at much higher rates on lower wealth borrowers and those with lower credit scores. And it can be 10 times the rate for those borrowers compared to others. And so, as Richard pointed out, when you lower that cost, it is extraordinarily progressive, and it can dramatically reduce the cost of the G fees for those borrowers. So I'm gonna move quickly through the next 2 points because I know we have questions for the panel and from the audience. The second, and I'm just going to touch on this relatively briefly, we have a paper coming out on this, is recapitalization really presents a historic opportunity to advance affordable housing and advance racial equity in the housing market. I really commend to people the paper cited by Susan Richards and Kins, and that's the August 2020 analysis by the CBO of the financial impact of recapitalization administratively. And one of the things it does is it prices and values the Treasury interest acquired in its rescue plan of the GSEs. And these are very significant assets. Under their proposals of a likely scenario, they value those assets at between 48 and 98 billion dollars based on either a 2023 release or 2025 release. And we submit that the value of those assets should be used to advance affordable housing and advance racial equity, including targeted down payment assistance. And it's consistent with the government's other assistance programs under TARP, which had similar regimes. The Treasury waives stock rights, for example, in both the AIG and the car manufacturer assistance plans. And they did that notwithstanding those two assistance plans actually ended up at a cost of nearly 30 billion combined to the Treasury. And as I think almost everyone on this call knows, that the GSEs have already repaid the Treasury over $100 billion more than the amount of assistance that they returned. It's been called dividends, but it's been a huge return. And so you could really jumpstart affordable housing at a time when it's badly needed in the country with that. And you could do it administratively. And that's a good segue to the final point about how to implement this. We believe that the transition to utility structure can be done administratively, and that is the more likely and, quite frankly, the safer way to do that. Folks who remember Corker Warner remember the calls from a significant part of the Senate that there should be 8 to 10% capital for the GSEs. And people were scrambling with coming up with models that would meet that. Legislation, again, will invite those same kinds of debates, which I think there is a broad consensus here that if anything, the 4% in the current rule is far too high, and 8 to 10% would be quite counterproductive. The Treasury, as Don has mentioned, really holds the cards because it has the economic leverage with which the GSEs cannot move forward. It provides the guarantee to the bondholders and the security holders. While it's irrevocable for existing bonds and securities, its Treasury has the discretion, although we think it would be quite disruptive if they did not continue with that. It provides the backup through additional capital infusions if the GSEs hit a financial crunch, which seems unlikely given the amounts of capital that people are talking about. And then we've seen already administrative steps that show how much can be done. You know, the common securitization platform was carved out of whole administrative cloth without legislative authorization. In this recent COVID crisis, we saw the GSE step in and assume servicer liability for advancing payments after more than 4 months and absorbing what Director Calabria estimates is a $10 billion cost of complying with the CARES Act through such incredibly helpful things like providing forbearance with deferral rather than increased payment or increased fees for borrowers. And then the very final part of this is these reforms absolutely have to be baked in each step towards release from conservatorship, because right now that can be done by agreement of FIFA and Treasury. Since FIFA has all, as Don knows all too well, the full power of the board and officers of the GSEs. As they move to out of conservatorship, though, the GSEs, if you will, become independent parties with legal obligations to their shareholders to maximize through reasonable means the value of the companies to the shareholders. And it's what that means is they won't be able or necessarily willing to take on further obligations that might reduce the value of the company to the shareholders. And indeed, their legal obligations say they shouldn't. And so it is really essential where now the government is providing great value to the GSEs, they can impose all of the constraints that we've talked about here today. So let me stop there and send it back to you, Isaac, so we can get to the great questions from the audience and the questions that you have.
Thank you, Mike. I agree that the audience questions are better than mine. And so I'm going to remind everyone how to send in their questions. Just as a reminder, there is a button at the bottom of your screen, a Q&A button. If you press on that, it will open up a new screen. You can type in your question and we will do our absolute best to get to it in the time remaining. I'm going to jump in and I'm going to go actually right back to Michael. So look, Mike, I'll give you a really easy, like super easy question, just to get it out of the way. How should the GSEs balance their charter duties versus profits? Just help me understand that from a foundational perspective.
So this is a place I think where it has to be mandated. It should not be the case that we ask the GSEs to take on what are expensive undertakings to serve a broader market rather than the most profitable. That, while both of them talk about and have demonstrated that affordable housing is, as they say, baked in their DNA, the question is how much of it to do, and neither of them should be disadvantaged by doing more affordable housing than the other. And so you need the robust and explicit affordable housing goals. You need them enforced with penalties to the extent that they're not reached. And so there is that tension. It's existed all along. We saw it have disastrous results in the housing crash of 2008. But you really do need to mandate it and make it the quid pro quo for the essential relief and assistance provided by the government, in our view.
That's helpful. Jerome, I want to thank you for your presentation. I want to throw the next question to you, if I may. This is one that I know came up after the previous paper was proposed back in back in the spring of 2019. And it's basically a broad question. Are we able to trust private investor incentives within a for-profit company that also has a public mission? I just want to get your thoughts about the push and pull of those different priorities.
Well, I mean, it certainly is a push and pull, but I mean, I think we believe that it can work if properly regulated. And that is where, having a strong regulator in place, having the kind of approach we have been talking about here. I think it is all in the quality of the regulation, but we do think a public-private model can work. It has worked. And, to produce a deep and liquid and, sizable market. Their mortgage guarantee business is solid. So I think we need to focus on those areas where we can shore up the model, and that is through, good regulation, baking in some of the reforms that have been made, and protecting all of the things that, I said before in terms of their mission, their affordable housing obligations, and all of that. And also having the type of federal backing that will give confidence to the market in terms of investing in these securities. So I think it really, I mean, that's, that's the benefit of the market utility approach, because I do think it offers the kind of protections around, guarantee fee regulation and regulation of the enterprises that I think is needed to kind of balance that push and pull.
Hey, Isaac, can I add in something to the question here?
Anyway, so that's perfect.
The balancing of emission and private shareholders is enhanced by having a utility style regulation. If you don't have it, then there's like competitive reasons to try to shortchange the low return mission activities to maximize the higher return normal activities. When you have utility regulation and they set price setting, not safety and soundness regulation, but price setting, utility style regulation, you're going to end up averaging, and they get to earn their average return. So there's an implicit cross subsidy built in. You can't obviously game it. You can't get better than the other guy in it. I think it's very well aligned to help integrate those two.
So let me stick with you for a moment. So your deck has in it a number of mechanisms, and you talk about discipline around it. So I want to give you just another minute to talk a little bit about how to institute those discipline mechanisms within the context of the craziness that is DC and the politicization of this issue that we're talking about.
Yeah. Okay, first of all, let's be realistic. Perfection is not possible in the world with real people and real politics, and the GSEs are so politicized, it's very hard to stay in the straight and narrow. Conservatorship, at least in my era, did a very good job, I think, of doing that. We got rid of all the excess investment portfolios. The people at Freddie Mac and I think Fannie Mae are actually very pro-mission. There is a self-selection of people who work there who want to do that kind of activity, but do it within not a government agency style where it's just spending the taxpayers' money, but this more private sector, good return, good risk management, and you have subsidies and cross subsidies, and you just deal with it overtly. To keep the politics, if you will, channeled as opposed to under the table with hidden subsidies and things, I think utility model is good. And you'd have to do everything. I think you should pull every lever to make it above board policy, not below the table political gamesmanship. And like I said, I think that means an independent commission to set the pricing, using one of the methods that in Washington is used to help keep things more in the straight and narrow, whether it's SEC style or PCA or BU style or whatever. A single director does not cut it. That has to change. Someone mentioned that in the prior panel. That has to change. It has to go to something else at the FHFA level. And so I think you just have to throw them all in, as much independence, professionalism as possible, and that is your best shot at it. Otherwise, it stays a conservatorship forever, and it's very subject to politics all along the way.
Perfect. So I'm actually going to read a question that's come in for Mike C via email. So we have multiple ways to get questions into the panel.
Okay.
I have the Q&A button on the bottom or my email. So Mike C, how do you get an adequate guarantee administratively without Congress? Investors view the GSEs as explicitly guaranteed under conservatorship. Why do you think the $250 billion backstop is sufficient when it's inherently finite?
Because it has shown during conservatorship, first of all, that it has been sufficient for investors. And we're talking about putting a vast amount of additional private capital in front of it, both through GSE capital and further risk sharing. As the paper points out, repeated studies of what a repeat of the 2008 crisis would produce in losses to the portfolio come in at losses of at or below, a little below $100 billion. And that is using some very conservative assumptions, including, has been pointed out, the modeling is done in a so-called runoff analysis where you don't get credit for the continuing income that you earn. You're required to pay all those losses just out of catastrophic capital. And even in the 2008 crisis, the vast majority, something in the mid 80% of borrowers continued to make their payments. So you compare that to a $100 billion loss to a $250 billion remaining capital infusion guarantee from the Treasury, and the current FIFA rule would require right about $285 billion of capital, which we think is too high. But you're talking about a backstop of more than 5 times a repeat of the 2008 crisis, as well as the explicit Treasury letter. And so that is shown to be adequate, and it's getting stronger with the additional capital. I would note one other thing just about how we structure this. You do, in a sense, have a check on the regulator that the FIFA director that we see today that would continue under an administrative plan as opposed to legislative, and that is Treasury is going to be a party at the table, and an essential one, because of its backstop, because of the role it plays. It's the guarantee, the government backstop that makes this market liquid and gives the GSEs such an advantage over others, private securitizers. And so that's not a complete diversification of authority, but a very substantial one. So it's not, you would not have just an independent director who is free to do whatever they want. And then also most observers think the independent director will soon be subject to removal at the pleasure of the president, which would be an additional check on, if you will, a rogue regulator or a captured regulator failing to enforce the model.
So we're in lightning round right now, 1 minute left, and I'm going to ask each one of you to answer briefly the next question. And Jerome, I'm going to start with you. Look, there is a change of administration coming next week, so Treasury Secretary will change. I do believe, as Mike said, that the odds favor FHFA Director Calabria being replaced at some point this year if the Supreme Court comes down the way that conventional wisdom suggests. So Jerome, starting with you, what is one or maybe two tangible policy recommendations you would make to Team Biden?
Well, first of all, they've got an awful lot of talented folks over there who have really spent a lot of time in this housing finance space. But I think there's a tendency to let this issue languish. And I mean, it's complex, politically fraught, difficult to get right for all of the things we've been talking about. But I really do think we should be moving forward and creating certainty in the market. This is an approach that, really has a lot of coalescence around it, and is a way to move forward. We also have enormous affordable housing challenges facing the nation, and I think we need full functioning GSEs in order to, help address some of that. So, don't let it, just don't let it languish, and let's move, forward with purpose and deliberation.
I'm happy to go second.
Mike, on you.
As several have noted today, the GSEs have provided incredible support during this COVID crisis, which has reinforced why we need them as public utilities. But much like what occurred in 2008, they need to up their game in 3 specific ways to avoid a repeat of lower wealth families being left behind in the recovery. So first of all, just on refis are overwhelmingly going, much like the initial PPT, to the wealthiest borrowers. Studies show that the average refi borrower, FIFA data is, they have 50% higher income than average GSE borrowers. So you're leaving the people who actually need the refis the most behind in that. Second, the GSEs still are not reaching Black borrowers, including millions of ones that Freddie itself documented are mortgage ready. Lending to Black borrowers is less than 5% for both GSEs on purchases and refis today. And then finally, there are going to be people who hit the end of forbearance and are not going to have restoration of income. And the GSEs need to step in there to help, like they helped out the servicers, helped out other families, and provide a bridge to those families until they get back on their feet, rather than have them lose their house through no fault of their own in this national systemic catastrophe.
Okay, I'll go third, Isaac. I'm going to be a little more generic. I think they need to put in a new head of the FHFA who knows the business and can therefore move with dispatch and expertise to do selective undoing of things that Director Calabria has done, which I think have been away from the main, I'll just call it out of the mainstream. Like the capital plan needs to be completely revised, for example. Begin, it will take a long time, but don't let it go any longer. Keep going on trying to head out of conservatorship. Fight for capital to be retained during these years. Start developing the utility model, which is not going to be an easy thing to do. It will take some time, and begin it. And just don't lose that momentum. And excuse me, there's a point of pride. I think you can unleash a lot of GSE management to solve these problems, because they have not been looked to for solutions in the last year and a half. They've just been told what to do.
Thank you, Don. I think that's going to be the last word here. I want to thank all of our panelists for being so generous with their thoughts and their time. I also want to thank NAR for their efforts on this front, but really across the housing policy waterfront. Look, as we all know, it's difficult to overstate how important housing is to families, to the economy, and to the country. And so to that end, I hope that we applaud anyone and everyone who is attempting to make our system safer, stabler, and overall better. And I think that this paper is part of that conversation undeniably. So if you want more information on this proposal, the paper, or anything else, additional information, including everything I just mentioned, can be found on NAR's website at the link below. And you should absolutely feel free to contact Ken Fears at any hour of the day for follow-up questions or comments. Thank you all for taking the time, and I hope you have a great day. Bye-bye now.
Thank you.